Hello and welcome to the American Compass podcast. My name is Oren. I am the chief economist at American Compass. And today we are joined by another chief economist, Anna Wong, the chief economist at Bloomberg Economics. Anna is one of my favorite analysts and commentators on all the crazy things happening in the economy these days. And she has a fascinating background. She worked at the Peterson Institute. She worked at the Treasury during both the Obama and Trump administrations. She worked at the Fed, and now she's at Bloomberg. And so I think she has a terrific perspective on what data matters and why, what models matter and why, what is actually going on in the economy right now versus what is just being played up or down for political reasons, and what we should be keeping an eye on going forward. I spent a lot of time talking about, how do we get out beyond the next 1 week or 3 weeks or so forth, and actually think about, what does all this look like for the next 3 to 5 years? And I was certainly struck by, how optimistic she is that a stable policy framework around, what we have today could very well be one that's very positive for investment, for reshoring, for productivity growth, and ultimately for strong economic performance. So I think you'll find that really interesting. Of course, got to tell you about Commonplace, a couple of really interesting pieces up recently. We had a great book review by Robert Bellafiore, Capitalism and Its Critics, looking at what is exactly wrong with capitalism, if anything, and whether the proper criticisms are the sort of narrow economic ones or much more holistic ones about what it's all for lack of a better term. And also had a great piece just now by Oren on Brightline, the private rail that is working in Florida and beginning to expand elsewhere. Maybe our railroads do need some more robber barons. So take a look at those. Of course, a lot more coming into your inbox every week. But without further ado, here is Anna Wong. And I am delighted to be joined on the podcast by Bloomberg's Anna Wong, one of my favorite Twitter follows, a must follow if you are paying attention to this economy at all. Anna, thank you so much for making the time to join us.
Happy to be here, Oren.
We talked on the Trumponomics Bloomberg podcast recently. There is so much going on in the economy with the economic data, with the models that do or do not have any sense of what is or will be happening. But I guess for listeners to this podcast, worth starting a little bit just with your background. Tell folks about where you've been, what you're up to, and what you're paying attention to.
Sure. My own background, I think I spent my formative years kind of similar, going through a very similar intellectual journey as yourself, because I think we are about the same age. So when I graduated from college, it was the era of China entering into WTO. And in college, it was like all about how, the first economics lesson we learned in college is how great trade is. And so I started working at Peterson Institute back right out of college. And from 2004 and 2006, and throughout those couple of years, it's all about China has been manipulating the currency, IMF is asleep at the wheel, Treasury has been pushing China to appreciate the renminbi, and global imbalances have been building. And that was basically how, the debate in Peterson Institute was every Friday, where we have these very lively debates. And then I went to graduate school at University of Chicago, came back out of graduate school after 6 years, and there's still global imbalances. And then I worked at the Treasury. In fact, I saw that you interviewed Brad Setzer, who's one of my favorite economists also. I was actually Brad's deputy at Treasury. And during that period, which is 2012 to 2016, we were all still talking about global imbalances at the Treasury. It's amazing. And after that, I worked for 5 years at the Fed. One of those years, I was seconded to the Council of Economic Advisor, and I was the chief international economist there from 2019 to 2020. So in the first Trump administration, towards the tail end of that trade war, and also in the middle of the COVID coronavirus. So I think, my professional background really shaped how I see the problems of the international monetary system, and also partly shape how I see how tariffs should be designed, and what's the normative need for tariffs. So
Yeah, it's fascinating. I mean, you've basically been everywhere and seen it all in terms of the, both Obama and Trump administrations, and at the Fed. Peterson Institute is a place that is, I think, generally thought of as kind of uber free trade committed. And yet, to your point, on questions like currency manipulation, imbalances, even 20 years ago, they were very much worried about those things. And so,
very much so.
yeah, so I guess without naming any names, I'm curious for your thoughts on just what is the distance between the actual issues and concerns economists have and focus on when they've been looking at the trading system versus the sort of unanimity they purport to present publicly about how great and wonderful it is. Is it fair to say there's a gap there? And how would you characterize kind of what economists actually think and are worried about when they're not speaking for public consumption?
Yeah, I mean, so Oren, the mainstream has really shifted, the mainstream economics discourse over the last 20 years. But 20 years ago, Peterson Institute was the folks there are of the older generation. They lived the 1980s, the 1970s, and Fred Bergston, for example, then director of Peterson Institute. I remember very clearly, he warned that if these global imbalances are not treated, or not basically, if the IMF were to continue to be asleep in the wheel, that there will be a backlash in protectionism, and it happened exactly as he saw it 20 years later. And um, I think I think that the civil servants and people who have worked on international monetary issue and international trade and finance, at Treasury, at watching these global imbalances building, all of them would agree that it is true that China has been relying on external demand excessively in the last 20 years. Um, and also Germany and Europe is also depending excessively on external demand to compensate for lack of domestic demand. And for 20 years, international institutions such as IMF had tried to, with the urging of U.S. Treasury, has tried to urge these countries to increase fiscal spending, and for China, increase the social security, the welfare system to boost domestic spending. And for 20 years, that dial hasn't really moved. And I think so. I think people who have worked in this area would generally agree that there is a problem. And I think where the differences lie is what's the solution to this problem. And I think the lesson from the past 20 years is clearly there are some um, flaws in the international institutional arrangement, such that it's making it hard to address these issues in a fast and effective way.
Yeah, it's funny. I use the example of, especially with respect to Europe. China, I think, kind of knows what it's doing and has no intention of changing. When it comes to Europe, that on both some defense and security issues and these trade issues, it's sort of been like the adult child in the basement that isn't getting a job and is just playing video games. And the U.S. has spent the last 20 years sort of suggesting nicely that maybe they should update their resume, or maybe they should go for a job interview, or, and they have just said no thanks. And we now seem to be, I mean, what Trump and the Trump administration have done is in a sense throw them out of the house and say, if you're not going to gradually make adjustments and make things better on your own, well, then this is what's going to happen. And obviously we now have massive amounts of disruption. And we are all now watching the data, trying to understand what is happening, trying to predict what is going to happen. What are you watching most closely? What do you think tells the clearest story about what's actually going on? What do you think are the red herrings that people are obsessing about incorrectly?
Yeah, so my primary audience for our work is Wall Street. I work for a financial media company, and our clients are, investors, traders. And so what we are watching primarily is the CPI data, whether this well anticipated inflation due to tariff pass through, when is it going to arrive, if it is ever going to arrive, and also simultaneously the jobs data. I think the key question right now is whether the deterioration, if there is indeed a deterioration in the labor market, would happen faster, swifter than the inflation that people are anticipating, and how that would affect monetary policy. So basically, the interaction of all these pieces is basically driving financial markets right now.
And for financial markets, I mean, ultimately, by implication, the punchline is what they really care about is whether the Fed is going to cut rates or not. Is that sort of where the rubber meets the road? Because for me, in some respects, there is so much happening in kind of the real world right now, right? Like, what do tariffs actually do to investment incentives and to trade flows? What is actually happening to employment? Especially when you layer on then everything on the immigration side and potential, contraction in the labor force. Whether the Fed funds rate goes up or down 25 or 50 basis points, it's not irrelevant, but I'm hard pressed to believe it is sort of the main driver of economic outcomes or equity values for that matter. Am I wrong, or is Wall Street wrong, or are we saying the same thing somehow? I don't know.
You're not wrong, Oren. You're just much more intellectual.
But that's not always a good thing, I suppose.
No, it's a great thing. In fact, those questions are questions that oftentimes with the fast pace that Wall Street operates on does not really have the luxury to think about. However, those are precisely the questions that affect things in the longer term that Wall Street cares about, such as what would be the Fed funds rate 2 years from now, 5 years from now, what would be the unemployment rate in 2028, what would be the election outcome in 2028. And many of the investors are not day traders, right? They don't care about the ultra short traders, they care about 1 week ahead, 1 month ahead. But we also have a lot of institutional investors, particularly in pension funds, who care about 3 to 5 years ahead. And for those folks, questions like what you are thinking about matter a lot.
And
so yeah.
well, so what are they, or what should they be watching? Because one thing I've thought about, particularly the tariff and trade policy, but it applies for immigration as well, is there's very likely to be short-term costs, right? This is a shock to the system. In some respects, an interesting analogy is to what happened when Reagan comes into office and, Paul Volcker does in fact jack interest rates way up. You do get a recession, but if you look even 2-3 years out, the results of that are extraordinarily beneficial. I think most people would say Ronald Reagan wins election, maybe the biggest landslide since George Washington. And so I guess I consider that 3 to 5 year window, whether you're talking about the actual economy or the politics of it, much more important than the 1 week or the 1 month. What data should I be looking at? What should someone who actually wants to understand what's going on that time frame find most
Yeah.
useful, or is it too soon to have anything useful to look at?
Yeah. So for that time frame, I think the most important thing is thinking about investment, as you mentioned, the longer run impact of the resolution of the trade policy uncertainty. So as we are getting into this phase of this trade war where it's deal-making phase. We're starting to see the shape of these deals and where tariffs eventually settled at. If tariffs eventually settled at about between 15 to 20%, I think there is a growing consensus among investors that the economy can handle a tariff rate of between 15 and 20%. And so this is why this could be one reason why the S&P 500 has kept on rallying, because people basically have moved past all the trade tariff driven news. What they're fixated on now is the next phase. How will the investment landscape look like? So what we do know is that resolution of uncertainty will by itself be a boost to investment. So there's that, 2 to 4 quarters, 1 year outlook. And beyond that, it is about the incentives for firms to make that investment. And I do see that in 2 to 3 years, that might be favorable. So for one thing, there's this cyclical rebound that you just mentioned. Suppose that this year we do see a slowdown in the economy, and I think that is indeed likely, just because just the tariffs alone is essentially a 1 percentage point contraction in fiscal impulse. Think about the 330 billion tariff revenues that we are getting this year. That's about 1%. But then next year, we have the One Big Beautiful Bill, that expansionary impulse kicking in around April's time. We estimate that will be an expansionary impulse of about 0.4%. So then you start, and on top of that, you have that natural cyclical rebounds from whatever happened this year. So next year, I think, heading into the midterm elections late in the year, things will start picking up. On top of that, beyond that, you also have continuing AI investment. The combination of the tax incentives in the tax bill, One Big Beautiful Bill, as well as the resolution in terms of the trade war, what kind of deals we have is looking like. The incentives are mainly trying to get firms to invest in U.S. Then that could, in combination, helped with push forward this AI investment that firms really are itching to do.
Yeah.
On top of that, aside from this, what's the opposite of headwinds?
Tailwind.
Tailwinds. That's right. I'm a sailor. I can't believe I don't know what I forgot tailwind. Yeah, aside from the tailwind from fiscal policy and also tailwind from trade policy, you also have likely the tailwind from monetary policy. So it's very likely the Fed will be cutting more steeply next year. In fact, Wall Street already prices in. So basically next year you have all these three tailwinds pushing the economy forward, which means, we know that monetary policy works with long and variable lags between, 6 months to 18 months, which means by 2027, 2028, you should see a lot of,
That's interesting.
much stronger investment.
Yeah.
So aside from that, I think when investors are thinking about 3 to 5 years, what I'm increasingly hearing is from some really smart traders is they're actually thinking about a world by 2028 where inflation is low, because AI is a very disinflationary force, which is very disruptive to the labor market, to youth, college graduate job opportunities. It's very disinflationary, and in fact, China is ahead in AI adoption than U.S., and you could already see what AI is doing to the job market for the younger people in China. So that could be us a couple of years from now, and that is very, very deflationary. So people are kind of thinking a world 3 years from now where you have productivity boom because AI adoption leads to shrinkage in workforce, yet output is increasing. You also have the tailwinds on investment from the three expansionary forces I just mentioned. So it's a world where, by the way, there's also the immigration. So, um, in various model of the neutral rate, R star, population maps to neutral rate 1-on-1.
Mm-hmm.
So if you have a 0.5 percentage point in population growth as it is this year. So population growth is falling from 0.9 to about 0.4% this year. That would map to a R star decrease of about the same magnitude if this fall in population is sustained in the next 4 years. So one could imagine that 3 to 5 years from now, you would see a lower interest rate, higher productivity, but some problems with labor market because of this disruption from AI.
Right.
Yeah, I
Although,
think that, yeah,
although if we have the disruption from AI eliminating sort of entry-level marketing and whatever other jobs in the white-collar space, exactly as a productivity boom and investment in reshoring creates a massive need for advanced manufacturing employment, we might have exactly the place for those people to work much more productively. We will have to see. I guess the thing I'm struck by in that forecast is it assumes that in fact the tariff environment that we seem to be settling toward, in aggregate at the 15 to 20% level, is consistent with incentives for increased investment. There is a debate, it seems to me, among certainly economists about whether tariffs in this range do in fact create positive incentives for domestic investment, or if they discourage investment and actually encourage deindustrialization. Among one theory is because of increased, cost of intermediate goods and inputs, or other sort of forms of friction. Do you discount that entirely? Do you think that's also a factor? And I'm curious both kind of in terms of, as someone who's worked with a lot of the economic models for a long time, obviously, and now being out on Wall Street, how do you see that argument playing out?
Yeah, that's an excellent question. And that gets into the evolution of how the economic profession look at trade issues. So I think the generation of trade economists at the Fed and in many of these international institutions, the kind of models they learned on trade are very much focused on supply chains. And so they focus on how tariffs would generally disrupt supply chains and productivity, and so that's the lens at which their models would be focusing on. That, in fact, tariffs could amplify the inefficiencies,
Mm-hmm.
right? Um, but if you zoom back to many, many years ago, I think you mentioned in one of your podcasts, Paul Samuelson
Mm-hmm.
mentioned in some very basic textbook, it says that there is a path to a welfare enhancing path from tariffs, and that is conditioned on the foreign trading partners do not retaliate. And the assumption that most people commonly make is that most likely other countries will retaliate. And what is so strange and what defies most people's implicit assumptions in their forecast that tariffs are extremely negative for the economy is the lack of retaliation, which is part of the deal that the Trump administration is enforcing.
Mm-hmm.
And I thought early on that this aspect of how they're handling the trade war this time around seems very different than the first time around. There's no condition in the deal in the
Mm-hmm.
previous trade war on with this, clear guidance that do not retaliate, right? So I think the likelihood of these tariffs being, getting closer to that path where it's possible to enhance welfare, the lack of retaliation plays a key role
Yeah.
in that.
That's a good point. And from the sort of business community perspective, you highlighted the certainty issue, which is one I totally agree with. That if you don't have any idea what the tariffs are going to be, it's very hard to expect them to boost investment. Is your sense either from the Wall Street side or among actual operating businesses that they are viewing this shift in trade policy as one that does promote more domestic investment, that is going to lead them to lean that direction? Or are they taking it as saying that says, forget it, how can you expect us to invest if we have tariffs like this?
Yeah. So I think there are so far not enough data point to make a concrete evaluation on that, but there are a few surveys on asking firms on their
Mm-hmm.
intentions, right? And so ISM Manufacturing puts out the semi-annual survey on their asking for surveying firms what's their plan for the capacity in the next 6 months. And I remember reading that some of the firms that responded that they plan to increase capacity definitely are in the metals industry.
Mm-hmm.
So the reason why I think the administration really went for the steel and aluminum tariffs was that in the first trade war, initially the tariff did boost domestic output and investment in the steel and aluminum industry. So we could see that in those survey responses that they are planning to
Mm-hmm.
boost the capacity. Another industry that I thought was kind of interestingly answering that they plan to boost capacity is apparels.
Hmm.
I thought that there's no way apparels is coming back to the US, right? Um, so, so, and then in terms of pharmaceuticals and semiconductors, so um, whether it's Trump administration the first time around or Biden administration, this country's effort to reshore semiconductor manufacturing has been happening for already, I would say, 7 years. Even when I was in the first Trump administration, there were work stream in trying to estimate how much tax credit should we give to semiconductor firms to lure them back on shore, right? So to build a semiconductor firm, it takes more than 3 years, at least 4 years.
Right.
But we have seen now in the last 4 years that there are many bottlenecks, including not enough labor in building these things. Second, there are some excessive red tapes in the conditions of these government money that makes it even harder to find the inputs to build these factories. And finally, there are issues with, for example, Intel domestically. Intel has a hard time reshaping their internal infrastructure to suit the need of the next generation of
Mm-hmm.
semiconductors. So I think at the firm level, also and also in terms of the policy, people are still trying to figure out what is the combination you need to successfully um, bring manufacturing back. So I would say that there is actually one very interesting case of a very successful reshoring of manufacturing into the U.S. That is SpaceX.
Hmm.
Um, you know, um, Back in 2010, I believe, it really looked like Russia and China are going to dominate space launches. It looked like there's no way we are going to catch up. But but somehow Elon Musk bring together all the pieces you need to, manufacture engines. And it started in, just finding engineers and machinists in California who could, actually use their hands to build these engine. And then you have to coordinate, keep everybody in one place instead of, doing this just in time inventory
Yeah.
where you're sourcing from multiple places. You have to make sure there are thousands of pieces fit together in one place. I mean, car manufacturing is another very complicated type of manufacturing that requires thousands, 2,000 parts to be in one place. But right now, auto manufacturing is spread all over, the world for U.S. production. I mean, it famously has a very long value chain, and
Mm-hmm.
that's the reason why in 2021 we saw such high inflation in car prices. So So I think it's possible to bring back advanced manufacturing to the U.S. And Elon Musk's SpaceX set an example of how to do it. But the question is, how many Elon Musks do we have in this country?
Yes. Yeah, well, and it's funny that Tesla is probably the best example in the auto manufacturing sector of trying to do the same thing and do more in-house, shorten supply chains, and had incredible success, at least until they gave it all away to China. But that is another episode for another day. The ISM example you gave, I think, is a great one of the kind of data I think that's really useful to look at. There are a lot of PMI surveys that also kind of go to people's intentions. And then there are a bunch of these different investment data series that we start to get. For better or for worse, the BEA does one, the Fed does one, the census does one. What do you think is most useful just in trying to get a handle on investment and capacity and what direction things are headed, say, over the 6 to 18 month window?
Yes, so there's a series that we track on Bloomberg Terminal called Capex Intentions. It tells you what firms plan to do 6 to 12 months ahead. Um, and I think there is a lot of bottled up latent intention to invest. Because we did see that before Liberation Day, many firms reported they plan to invest. And I think partly because of the uncertainty introduced by the policy experiment the administration is trying right now, that those potential investment were kind of like bottled up. And so really it's about unleashing that bottled up investment latent demand. And I think the moment that the Fed started lowering rates is when we will start seeing many of this
Interesting.
investment coming in the pipeline.
I guess the other side of that of the picture there's the sort of demand for output. There's also just the supply of capital, and there's an interesting parallel debate to all of these trade debates going on about capital flows. And we have this interesting phenomenon right now where an element of a lot of these trade deals that the administration is striking calls for I mean, trillion plus dollars in aggregate of additional capital into the US for investment. On one hand, you might say that's fantastic. This is what we need. On the other hand, people rightly point out, but massive amounts of foreign capital flowing into the US are the flip side of a trade deficit. This is sort of part of the problem. How do you evaluate that? Should we be excited about the foreign investment flowing in? Is it short-term problem, long-term benefit? I'm very curious what you make of it.
Yeah, I think this is there is a certain paradox in that indeed if you're relying on external savings, external investment, then it will boost the dollar. And a strong dollar is not it's I have not seen a country which can successfully revitalize a manufacturing base with a strong currency. And so that's one issue. So I think, however, what the imports tax, the tariff does essentially is supposed to force more internal savings. So if you think about the current account deficit as from a national saving and investment identity. So if the trade deficit were to narrow because of imported tax, where consumers are substituting away from foreign goods toward domestic goods, then you should see smaller deficit, but it could come from just increasing your domestic saving rates, right? People could just be buying less stuff. And so you have higher domestic saving. And domestic saving is actually both a function of private savings and public savings. So you think about these, 330 billion per year of tariffs. That should, over the next couple of years, help reduce the deficit, the primary deficit. So that boosts domestic savings. And then on the other hand, also, people are buying less stuff. We could already see it in retail data that people are buying less stuff. I mean, that's clearly the case. So that means that more investment, domestic investment in the country could be financed by domestic savings. So I haven't done the work of tabulating the total investment that these trade deals supposedly will bring, but I have to imagine that that number will be dwarfed by the increase in domestic savings as a result. So that's I think that's one way to square the circle. But again, it's a very narrow path. It's like a knife edge thing. There is an optimal path. You could finance. I mean, in fact, that's how the East Asia, the growth miracle in 1990s, 1980s happened. They are financing, you know, investment with a lot of domestic savings through, in China's case, forced domestic saving mechanisms. So tariffs, in a way, is one way of forced savings, right? Because it forces people to spend as less.
Yeah. Well, it's a great point that I think a lot of the skepticism of tariffs you will hear from economists comes down to trade imbalances are a function of savings and investment. Trying to do something on the current account side can't possibly accomplish anything, but that assumes that savings is exogenous. If national savings is endogenous to your trade policy, then in fact, as you're describing, something like a tariff, both in its effect on consumption and its effect on the budget picture, will in fact affect the savings rate as well. And then I guess we would have we would have some more of that capital to invest.
So I'm saying it's a plausible path.
Right.
It's a plausible path. And so I think these investment that's part of these trade deals is not necessary in a sense that in fact I think as long as you increase domestic savings, create incentives for people to save more to finance domestic investment, that is already good enough to achieve the vision, which is closing the trade deficit, more domestic reliance, and not causing an overvalued dollar, having a not necessarily weak dollar, but just not overvalued as it has been in so many years, and then that could get you a higher chance of having a revitalized domestic manufacturing base.
No, that makes sense. I think, in my view, what's most valuable if we get these deals right isn't necessarily the cash in a sense. It would be if it's actual greenfield FDI, meaning much as Toyota and Honda came and actually built plants in the American South.
Know-hows.
That's exactly right. If the Korean shipbuilders are coming and setting up shipyards here, if the German machine tool companies are coming and setting up machine tool plants, that's what we're actually asking for. If it is just recycled dollars back into our financial markets, that is something we already have. we already have quite a lot of, I suppose. But
it's like the reversal of the growth model of the East Asia miracle back in the 80s, 90s, which is, U.S. and other Western firms invest in greenfield FDI and carry the know-how with them to help them. And it's now it's like the reverse of that.
That's
process.
Well, we gave it all away, and I guess we have to get it back somehow. But the last thing I cannot let you leave without pulling you into the great inflation debate, which is 20% about what is the actual expected price impact, and 80% in my mind on the question of, is that actually inflation, at least in a sort of monetarily cognizable sense? When we were talking about this back on the Trumponomics podcast at Bloomberg, you made a really important point about the different types of economic models and how they even understand tariffs and what you would expect the effect to be. That one I was the guest, so I didn't want to be like, oh, I just want to talk about that more. But now I'm the host and can talk about it as much as I want. So was wanted to ask you about that. What thinking about, from a Treasury perspective, from a Fed perspective, what are tariffs? What do tariffs do to price levels, and how do monetary policymakers have to think about them?
Yeah, I think there are really an assortment of models out there that have a range of prediction on inflation from tariffs. It's really about what models you want to focus on. So I mentioned in that other podcast that, in fact, the Fed back in 2018 had a FOMC presentation where a very well-seasoned economist explained that, well, if 15% of tariffs were mostly imposed on intermediate goods, then you would basically have a deflationary effect over the long time. However, if most of the tariffs were imposed on consumption goods, then there will be a one-off inflation, and then inflation it would be a transitory inflation. Um, and the one reason why the tariffs on intermediate goods would show as it would be deflationary was that, well, you import so much intermediate goods, so supposedly then the some of the dollar appreciation should be offsetting some of the inflation from the intermediate goods. And since CPI is actually final consumer prices, the intermediate goods would not be passing through as much of those price increase on consumer
Hmm.
goods. So they're not assuming 100% pass through from intermediate goods to consumer goods. So there's an element of firms would be absorbing a lot of that tariff pass through margin compression. And as a result, that would compress investment and hiring, and much of the burden of the tariffs would be fallen on the labor market and with higher unemployment rate, but therefore it will be disinflationary. So I think that somewhere in between those two models where, it's deflationary versus one-off inflationary is where we are at right now. Since in the US, we import about 75% in intermediate goods, and the rest of the 25% are basically consumption goods. So, and another element of these in thinking about inflation is just understanding the nuts and bolts of what constitute the CPI.
Hmm.
So the CPI is actually very driven by services categories like hotels and airfares. In fact, in the last 4 years, oftentimes the surprise on CPI data is due to hotter than expected hotels and hotter than expected airfares. And those categories are very sensitive to sentiment. And given the size of these trade policy shock and also the Doge cuts, and we've seen that the University of Michigan sentiment index is very, as you could tell, is very politically driven, and people read the news and they become very depressed about it. And so people have not been traveling as much or spending as much in hotels and airfares. So that's also a very important part of the story of disinflation. So, and that's what happened in the last four months. Basically, the disinflationary effect from both, firms' margin compression and also these travel and airfares, basically the top 20% of the income distribution not spending as much, those more than offset the tariff pass through on the consumer goods, which we estimate to be roughly between 6 to 10% of the CPI weight.
Hmm.
So basically, what's happening in the rest of the 90 to 80% of the CPI basket more than offset the inflationary or one-off price level increase in that 6 to 10%.
Yeah. And on that 6 to 10%, is your sense that the pass through has been happening as quickly as the tariffs go up, give or take, or that no, there's been inventories, there've been other things we should still expect to see a much bigger punch, headed into the fall?
Yes. So the common story you hear is that we haven't seen any pass through yet. It'll take more time. But keep in mind that 4 months ago, most economists on Wall Street is saying maximum inflation pass-through will happen by May. In May is CPI, and it's now August. So in fact, next week's CPI will be super important because uh, a lot of economists, including the Fed and Powell himself, says July is the time where firms should run out of those stockpiled inventory. We should see more pass through. And I think the flaw of these argument is that, in fact, if you look at the details, and we do look at the details, my team actually scraped 12 million of prices online just to see what's going on in these like real-time pass-through. And we actually have seen pretty brisk pass-through in the past 3 months already in a whole range of consumer goods. For example, audio equipment have already increased prices by over 10%. And kitchen appliances like your, Ninja toaster or ovens, things like that, and some of the major appliances have already passed through quite a lot. And overall, we estimated that about, I would say, for every 1 percentage point increase in tariff, we have seen 28% of that being passed through to consumer prices already. But what's interesting about the prices we have scraped for July is that we're starting to see some tariff pass through having peaked in the previous month. And we're starting to see a slowdown in the rate of change of price increase. So this is the second derivative, right? Still positive inflation, but at a lower pace than the last month. And I think the reason is that consumers are pushing back against the stuff. And I think people have a scarred or a PTSD from the last 4 years of high inflation. If they think that if you have a supply shock, you're guaranteed to have inflation. I think the mechanism people are thinking of how tariffs would translate to persistent inflation is that somehow inflation expectations are unanchored from the last 4 years. And therefore, as long as you have a supply shock, you're going to see persistent inflation. The missing part in that is that the last 4 years also saw a big income shock, a positive income shock, which is absent this year. As I mentioned, the tariffs which is not offset by any income boost, is a 1 percentage point fiscal contraction for this year, basically. So as a result, this supply shock is not exactly translating to inflation because people are also pulling back. They don't have the extra money to buy this more expensive stuff. And that's what we're seeing in the real-time data, that people are starting to pull back. These sporting goods are very exposed to Chinese tariffs. In fact, they are one of the most exposed. And we saw very brisk pass-through in the first 2 months of the year. And I wonder if it's because, it's also generally the top 20% highest income people buying these sporting goods. It's so auxiliary to your everyday life, right? And now we're starting to see a drop in prices. People just can't afford it anymore.
Interesting. Well, we will all keep an eye on the CPI report next week. We will eagerly watch for thoughtful economic analyses and those who tell us that, no, August, wait for August. August will be the month. But regardless, we will be following you and your analysis, which I think is consistently the sharpest that I am seeing out there. So I really appreciate you making the time. And we'll probably have to talk again sometime soon.
Okay, thank you, Oren. Happy to be here.
And we will be back again soon with another episode of the American Compass podcast.